Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. My goal is to help you put your money where your mouth is and invest in great companies. If you are like me, you love food and you love investing. So, it only makes sense that you will love the Food Fund too. In this video we will be exploring Hershey and finding if the world famous chocolate confectionery company would be a sweet addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Starting with the 1-year chart, we see that Hershey had a CAGR of about 22%. Zooming out to the 5-year chart, we see that Hershey had a CAGR of 23%. These are great, consistent returns. It is looking good so far. Now let's look at the fundamentals. Gross margin looks delicious at 43%. Revenue has compounded at 8% over the past 5 years, most recently hitting $10.7 billion on a trailing 12-month basis. Great revenue results. Looking at free cash flow, we see a 10% CAGR over the last 5 years, with CapEx growing at a 13% CAGR. Stock-based compensation is growing at a 8% CAGR. While I would generally like to see CapEx decreasing over time and certainly not growing at a faster rate than free cash flow, CapEx is so much smaller than free cash flow that it is not an issue. Stock-based compensation is minuscule and growing slower than free cash flow. Now, weighted average shares outstanding has been decreasing. This means that Hershey is buying back shares. This decreased share count will increase the per share metrics and increase the value for shareholders. Next, return on invested capital. Return on invested capital decreased during the period at a CAGR of about -3%, going from 31% in 2018 to 27% most recently. While this decrease over time is not ideal, a 27% CAGR is still very strong. On to the cash conversion cycle, a measure of operational efficiency at the company. Going from 52 days in 2018 to -14 days most recently, Hershey is demonstrating improving supplier leverage and inventory control. A negative cash conversion cycle means that a company's inventory is sold before they have to pay for the goods to make the product. Love to see negative cash conversion cycle. Last, let's explore Hershey's debt metrics. For Hershey, the current ratio is 0.8, the debt to equity ratio is 0.4, and the net debt to EBITDA ratio is 1.8. This is a very strong debt profile. So now that we know all about the fundamentals of Hershey, should it be added to the portfolio? Before sharing my final thoughts on that, please subscribe, like, and share this video. Your support means a lot to the Food Fund and your continued viewership is a huge help to grow the channel. Now, let's get into the final thoughts. Okay, let's write out some key values for Hershey. This amazing confectionery company has a gross margin of 43%. As mentioned in other videos, I like to start with gross margin because if this sucks, then no matter how great the other metrics, the company will be terrible. Here, the gross margin is sweet. The 5-year revenue per share CAGR is 8% and the 5-year free cash flow per share CAGR is 10%. A return on invested capital of 27% is really good and shows very great capital efficiency. Next, the cash conversion cycle of -14 days is very nice. Regarding the debt, a net debt to EBITDA of 1.8 means the company would take a little under 2 years of EBITDA to pay off its debts. This is one of the best companies we have analyzed so far. From a fundamental standpoint, Hershey is strong and I would only expect it to continue to grow. Now, let's look at valuation. Hershey is somewhat overvalued relative to the S&P 500 with a ratio of 1.4. As we have previously mentioned, strong fundamentals often command a premium to the market. Given the strength of Hershey, this premium seems reasonable. The price to earnings growth, or PEG ratio, of 2.9 tells me that Hershey may be a little expensive relative to its projected earnings growth. In summary, Hershey is a strong, free cash flow producing company and the valuation may be reasonable here. Definitely putting this sweet thing on the watch list. Many thanks for watching. What do you think about Hershey? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.